Welcome back to Turning Hard Times to Good Times. I am your host, Jay Taylor. David Stockman was my guest on September 3rd. The title of my September 3rd show was, Can the Empire Survive a Failing Economy? I started out asking David whether he thought the U.S. economy would begin a recession before the end of 2019. He didn't exactly answer that question, but rather looked to November 2020, when the next presidential election takes place. He suggested that by that date, a recession is highly likely, in which case a radical anti-capitalist president like Elizabeth Warren is likely to emerge. David explained how layer upon layer of debt over credit cycle after credit cycle is likely to result in a massive stock market decline followed by a deep economic recession which will all but ensure Trump's defeat in 2020. And he explained how that is likely to lead to an even deeper economic demise in the years to come. Not a happy picture, to be sure, but you owe it to yourself to listen to David's well-thought-out reasons to be prepared for an unpleasant future for the American empire. Here's what David had to say.
Well, it's not the greatest economy ever. It's the greatest fantasy ever. But it long predates Donald Trump. This has been going on for years, if not decades. We're near the very end of the longest business expansion in history, as tepid as it has been. But we're at month 121. The pure calendar odds are against, this expansion lasting much longer. And that would be true even under normal circumstances because recessions obviously haven't been outlawed. But in the current circumstances, there are so many built-up distortions. There is so much built-up debt on the economy. We thought we had a wake-up call in 2008 when the crisis came and Lehman filed for bankruptcy, etc., and everybody said, it was the subprime and too much speculation in housing and a massive amount of mortgage debt and all the rest of it. But we had $52 trillion of public and private debt on the U.S. economy at that point. We didn't learn a lesson at all because there's $72 trillion of public and private debt on the U.S. economy today, or 20 trillion more. The business sector had 10 trillion of debt at the eve of the crisis a decade ago. Now it's 15.5 trillion. The household sector was already buried in debt. It was what I call peak debt in 2008 at around 14.5 trillion. Now it's nearly 16 trillion. Yeah. And of course, we don't even have to talk about what's happened to the government accounts where debt is more than doubled to 22 trillion. But there's a bigger point. And that is we now have so much structural deficit built in, and Trump has only made it worse by adding to the deficit in a discretionary way at the top of the business cycle. Unheard of. He took it over $1 trillion in year 10 of an expansion when you're supposed to be shrinking or disappearing the deficit. So all of these factors, to say nothing of the massive speculation on Wall Street, and in the modern world, recessions don't cause Wall Street to fall. Wall Street bubbles eventually collapse. They cause panic in the C-suites of corporate America. They begin to throw employees overboard, engage in announce huge restructuring plans to somehow turn around the fall decline of their stock prices, and that's what triggers the recession. That's what happened in 2008, 2009. It really happened in 2001, 2002 as well. So we have this bubble that's gotten even more fantastic during Trump's time in office. It's any day it's going to collapse, and I think the so-called sub-zero debt phenomena or crisis may be the catalyst. But in any event, when Wall Street really begins to unwind, there's nothing down below. In other words, the market is traded by what I call chart monkeys today. And, they're looking at the 200-day and the 50-day and the 20-day, all kinds of other ratios. But it is not grounded in the fundamentals of either the global economy or the domestic economy. So if we ever have a big break that's not expected, and these chart points are lost, there will be massive selling. 80% of the volume, as we all know, is basically indexed or passive or ETFs or algo-driven quant trading. So when the thing breaks, it will be quite dramatic. It will be quite, violent, and the economy will go down with it. Well, that happened before November 2020. I think the odds are pretty high.
Right.
I think we're sort of in the final days of this fantasy, as I call it. And then the danger, of course, is that if the stock market breaks and it triggers, as I'm sure it will, another serious dislocation, recession on Main Street, it's absolutely certain that Trump will be repudiated by everybody. He's made a huge mistake. He called it a big, fat, ugly bubble in the campaign during the 2016 campaign. He was right then. He was in office less than a month, and he had embraced the thing. And all of a sudden, it was the Trump miracle. And so the point is, I have a phrase: you boast it, you own it. And he has boasted this economy like no sane person ever would, or prior president or politician has. And when the whole thing breaks, when this whole fantasy, which he didn't create, he inherited, he made it worse, but when this whole fantasy breaks, it's going to be what I call the great Trumpian recession, and he will be in total disrepute, as bad as Nixon was in 1974, summer of 74. I was a kid there when all this happened. And whoever the Democrats put up, including Mickey Mouse, will probably win the election. Now, the danger, if you're thinking about the market and your position in it, or whether, there's still some upside left, the danger is, I don't think Biden's going to survive the primaries. He's quasi-senile, and he's making so many mistakes that at some point his support, which is a mile wide and an inch deep, will suddenly vanish. And, Bernie's way too old. You'll have Elizabeth Warren as in the pole position. And if she becomes a Democratic candidate after a stock market bust and an economy that goes back into soup, hang on to your hat, because she'll win. And it will be populist demagoguery against the 0.01% like we've never seen before. And if this fantasy breaks, that message, as wrong-headed and as dangerous as it is, will likely prevail, and then we'll get really bad policies, like a wealth tax or some major increases in government spending. Look at all her free stuff programs. I mean, Medicare for all and the Green New Deal, and canceling most of the student debt and all the other things she's going to do. We'll be in big, big trouble beyond where we are already. And this would be my final point here, Jay. We're heading in the 2020s, and if people don't understand what I call the demographic calendar, they're making a big mistake, and that is everybody. I was born in 1946, the leading edge of the baby boom, and it lasted till 1962, when there were roughly 80 million babies born, and they're all retiring in the 2020s. Just do the math, and then that means that the cost of Medicare and Social Security and Medicaid, the whole what I call welfare state, is going to explode at a very time that we've got the empire so embedded everywhere around the world, and Trump has built the defense budget up, in a crazy manner by another $100 billion a year. There's no way out of that trap, and that's exactly what we're stumbling into. And this time, and I guess this is the takeoff point for the next issue, the Fed or any other central banks can't rescue us because they're out of dry powder, and sub-zero debt is really what proves it. That's the skunk in the woodpile, the giant skunk. And people need to understand that it is symptomatic of the fact that the central banks have finally, shot their wad. They've driven themselves into a corner that they can't get out of, and have totally destroyed in the process the bond market. There is no yield left in the world except for dollar securities and even the whole yield curve for the U.S. Treasuries. Last week traded for the first time under 2.0%, going all the way out to 30 years. Never happened before, and we do have 2% inflation, which means plus or minus, it wobbles up and down a little bit, but honestly measured, it's easily 2%. It means the entire yield curve of the benchmark securities of the world, the U.S. Treasury market, is now negative after inflation or in real terms. Now, you can't run an economy where debt doesn't cost anything, including 30-year debt, and that's exactly where we are. And when the bond market finally does implode, from all this central bank bond buying and yield crushing, that's where we get to the end of the road.
Yeah. Well, David, what do you think the odds are? I know in real terms the interest rates are negative now, essentially. And of course we pay taxes on this Treasury income and so you factor that in. We're deeply negative already. So what do you think the chances are of nominal U.S. rates going negative, and what impact might that have? Alistair McLeod last week talked about the uniqueness of the world's reserve currency going negative rates, and how since everything has a time preference value to it, your ounce of gold, your dollar, whatever. If they force the interest rates down below that preference, that time preference of the dollar, which they're doing obviously, and if it goes negative, Alistair's point is there's no reason to hold dollars anymore. You may as well just go out and buy stuff, starting with the most liquid and portable gold and silver and that sort of thing. But first of all, what are the chances, do you think, that the U.S. Dollars that we do go into NIRP, that we have a negative interest rate policy here? And if that happens, how do you see it playing out?
Well, that's a great question. And if it does happen, if the U.S. Treasury yield curve goes negative in nominal terms, I would say it's all over except the shouting. Because let's be very clear on how we get negative rates across the yield curve, not just on the administered rate for the federal funds. It's not even a real market. Nobody trades in the federal funds market except a few government-sponsored enterprise, the federal home loan banks and so forth. But when you get the entire curve negative, like it is in Europe entirely, the entire German yield curve is negative. Even the 10-year bond is negative 0.7 last week, and the 30 was under. But when the entire yield curve is negative, it means there's massive speculation underway. In other words, speculators are front-running the market and what they think the central banks are going to be doing. And when the central banks start buying again, which they expect the ECB will announce shortly, buying bonds, they want to buy. The speculators have learned and gotten rich doing this. They want to buy what the central banks are going to be buying next week and next month. And so you have all these speculators piling on and driving up the price of these bonds, and therefore the yield to lower, and eventually negative levels. In other words, there is 17 trillion of negative yielding government and some investment grade debt in the world, but only a tiny piece of that was issued with negative coupons. All that has some kind of coupon, it might be 0.5% or 1% or even some of them are 2%, but they're yielding negative now because their prices have been driven way above par. The problem with that is that's speculation. No one's ever going to be paid back a bond at 130% or 180% of par, where many of them are trading today in the global bond market. They're going to go back to 100. They're going to go back to par. And somebody is sitting there right now on a 10, 30, 60% loss, thinking there's always a greater fool that will buy this bond. In other words, they're buying bonds for price appreciation when bonds are supposed to be safe, modestly yielding instruments. They've turned the world upside down. This is what the central banks have done. That's why we have negative yields, and that's why it's a self-limiting phenomenon. It cannot go on much longer because in any speculative bubble, sooner or later, the last sucker does the last trade, and then it's look out below because everyone wants to sell, and there's no bid underneath. Now, can I use this one example? I know you asked about the dollar, but the point is, if the entire U.S. dollar bond market, which is 16 trillion just for the tradable government bonds, but if it went negative, the 10-year or the 5-year, it would mean that this speculation that has driven Europe, to these absurd levels has hit the U.S. bond market. And it would be only a matter of counting the days or even hours before, that bubble breaks, the mother of all bond market bubbles, as I call it. And then we would have a crisis in the monetary system worldwide. The central banks would be in total disrepute. The only good thing for some people, including myself, and I'm sure many listeners, is gold will soar when finally the bond bubble breaks and the central banks are totally repudiated. So let's just take one example of how crazy this is, but it's simply a microcosm of what's going on in the sub-zero bond market, the destruction of yield, as I call it, by the central banks, and what the ultimate case would be if we finally approach that with the U.S. Treasury market. And remember now, we're not that far away. If you go back and look at your charts, you will see that in last fall, September, October, the U.S. Treasury was trading at 3.24%, the 10-year. Okay, 3.24%. It ended Friday somewhere around 1.5. We've had a huge yield collapse since then, which means implicitly the price of bonds has been going up. So take the Austrian 100-year. Now, why anybody would even buy a 100-year bond today, who knows where Europe will be or whether the state of Austria will exist 100 years from now. It barely emerged 100 years back out of the Versailles Conference, after the Austro-Hungarian Empire was dismantled. But as the case may be, that bond was issued in September 2017 with a 2% coupon. A year later, this past June, it was trading at 160% of par. The yield was down to 1%. The smart banker said to the government of Austria, they're eating this thing up. Why don't you reopen the issue and sell some more? They sold a couple billion more, and the bond yield kept falling. The price in the last couple of days was 210% of par.
Yeah.
This is crazy.
Yeah.
Okay? The thing is yielding less than 1%. It's a 100-year bond. And there's a built-in 60% loss to anybody holding that bond today, absolutely guaranteed, even if you last 100 years, because even 100 years from now, the Austrian government contractually is not going to pay back more than 100 cents on the dollar. Whoever paid 210 cents is out of their mind, but they think there's another sucker around who's going to pay 220, and they can capture the capital gain. Now, Jay, this is really big. From June, when they reopened the issue at 160 to last week at 210, someone on leverage, these traders buy this on repo, someone on leverage has made, a couple 100% profit on a bond. This is crazy as hell. This is, the final blow-off phase of this whole bubble finance cycle. That's why your point about if the U.S. Treasury market succumbs to sub-zero or close in the next month or two, truly, it is all over except the shouting, because it will mean the global bond market has been destroyed by the central banks.
So just to summarize David Stockman's message, first, we have a massive debt problem that the central banks have no way of getting out of. They can only delay the pain by printing ever-increasing amounts of money, which leads interest rates even lower. That has been the policy for at least a couple of decades, and what has resulted now is a massive speculation in the bond markets so that the price of bonds far exceed the intrinsic value or their face value. And so the bonds are actually now deeply negative in value, as sovereign governments will never pay more than the 100% contractual value embedded in the bonds. Thus, we are in a massive speculative bond market blow-off, just as John Rubino suggested on my September 10th show. And that will likely lead to a bond market collapse and huge losses by speculators holding those bonds when the market music stops. With bond prices collapsing and yields shooting higher, the equity markets are likely to get slammed really hard. As equity markets collapse, if history is prologue, we can expect quantitative easing to begin more aggressively than ever. But if that's the case, and if central banks are able to suppress interest rates, we should then see the entire commodity market complex begin a major bull market. That would indeed fit very well with Alasdair MacLeod's call for a rise in prices across the entire commodities complex, especially if the U.S. enters negative interest rate territory. It also is in sync with Michael Oliver's work, which suggests that we will see the entire commodity complex start a major bull market, along with a fast and furious equity market collapse. Michael's work has called for a counter-rally in U.S. T-bonds, in the Treasury markets in general, when equities go into a tailspin. But he also sees a major collapse ultimately in U.S. Treasury markets, with rates rising very dramatically when confidence is lost in the Fed's ability to lift America out of recession. No one knows for sure how these markets will play out, or how much longer our Creator will allow the American empire to do its dastardly deeds. But in terms of our existence within our current four-dimensional time-space continuum, one thing seems sure, and that is owning gold, which has been the most trusted money for thousands of years, not because government declared that to be so, but because the properties given to gold by our Creator have caused free markets to choose it as money and their most desired medium of exchange. Gold has lasting value as long as the universe lasts, and because we must do the best we can for the survival of our families and friends, any sound, rational person who has studied history and the current massive mess created by the Fed and other central banks, not to trade some of our soon-to-be worthless dollars for gold would indeed be a crime.